All right, it's noon Eastern, 9 Pacific. Why don't we go ahead and get started? Welcome to Dorsey & Whitney's webinar, Regulation A+, New Financing Opportunities for the Canadian Markets. This webinar is being presented by the Seattle, Toronto, and Denver offices of Dorsey & Whitney LLP, one of the premier U.S. legal advisors to Canadian companies and institutions in their U.S. cross-border needs. Dorsey is the only U.S. law firm with offices in both Toronto and Vancouver where we practice only U.S. law and do not practice Canadian law. Each of today's three presenters is a partner in Dorsey's Capital Markets and Corporate Compliance Practice Group, who focuses a significant portion of his practice on the U.S. legal aspects of Canadian-U.S. cross-border financings and M&A transactions, as well as corporate governance, SEC reporting, and stock exchange compliance. In this webinar, we will discuss the changes to SEC regulations that will be taking effect next month, known as Regulation A+, which will allow certain U.S. and Canadian companies to conduct public offerings of up to $50 million U.S. without becoming full SEC reporting companies. Our presentation will be divided into three parts. First, we'll provide a brief overview of the existing Regulation A exemption as in effect prior to these amendments and the origin of the amendments that are just now taking effect. Second, we'll explain in detail who's allowed to use new Regulation A+, what types of offerings it can be used for, and what companies are required to do to comply with the exemption. Lastly, we'll provide our thoughts on when Regulation A will be most useful and where we think it won't be very useful, focusing on what's most important for the Canadian markets, specifically Canadian companies doing deals in the U.S. and U.S. companies doing deals in Canada. During the presentation, we'll have participants in listen-only mode. However, if you want to ask any questions of the presenters, you should see on the left side of your screen a white chat box. You can submit a question by typing it in that box at any time. We will attempt to answer all questions that have been submitted either at the end of the presentation if there is time or by following up with you afterward individually. Our first presenter today is Richard Raymer, a partner in our Capital Markets and Corporate Compliance Practice Group and the head of our Toronto office. Rich?
Thank you very much, Chris, and welcome everybody. Pleased you could all join and hope to make this a useful use of your time. So Regulation A has been around for decades. It's been on the books for a long time, and most folks hadn't heard much of it prior to these amendments. And although it has some fairly compelling features, such as the ability to publicly offer free trading securities without triggering ongoing SEC reporting obligations, we haven't seen it used much. In fact, statistically, I think in recent years, there's probably been, or there has been, Regulation A offerings in the single digits as compared to Regulation D offerings in the range of 10 to 15,000 offerings in a given year. And so, given these compelling features of effectively public offering of free trading securities without the SEC obligations that come with a traditional public offering, what's given rise to its limited use, and it really comes down to two features. One has been the fact that the offering size has been limited to an aggregate of $5 million in any 12-month period. Prior to 1992, that number was $1.5 million. And the fact that an offering circular was required to be prepared, submitted to the SEC, and that there was no corresponding state preemption of the offering. So the offering document needed to be filed with both the SEC and the state regulators in each state that the offering occurred. So that led to a fairly onerous regulatory process for a fairly small maximum offering. And so Regulation A has kind of languished for certainly as long as I've been practicing, and I suspect long before that. Then in 2012, Congress adopted the Jobs Act. And the Jobs Act was really an attempt to foster capital formation in the U.S. In the wake of the 2008 financial crisis. And the Jobs Act included really a range of new rules and kind of modernizations and streamlining of existing rules, which touched on both private and public offerings in an attempt to make those make them more effective, certainly for growth companies. Under the Jobs Act, Congress directed the SEC to update Regulation A in certain very important ways, including increasing the maximum aggregate offering size in any 12 months from 5 million to 50 million. It brought forward the ability to perform a Regulation A offering on a public offering basis and to issue free trading securities at the completion of that offering. It also imported into Regulation A the concept of testing the waters, which we've seen under the Jobs Act in the public context. And while in the public context, testing the waters has some limitations as to the investors that you can test the waters with, no such limitations apply to Regulation A offerings. So permits Regulation A, potential Regulation A issuers to assess the appetite for their offering prior to commencement. Congress also, in adopting the Jobs Act, permitted the SEC to require certain ongoing reporting. And in the past, kind of up until this point, Regulation A did not require ongoing SEC reporting following completion of the offering, but Congress permits in the Jobs Act the SEC to adopt ongoing reporting obligations, which really take the form of kind of pared down reporting from what we see with SEC companies, and those points will be touched on in more detail later in the presentation. And so this package of changes have been referred to pretty widely as Regulation A+ since adoption of the Jobs Act. So the Jobs Act was adopted in 2012. The SEC drafted proposing rules which were published in December 2013 and open for public comment. There was some fairly robust public commentary. The SEC went back and kind of digested that commentary and drafted final rules, which we saw in March of this year. Those rules are drafted as amendments to the existing Regulation A, and those rules will become effective and available to issuers beginning on June 19 of this year. So some of the key features of Regulation A+ is continues to permit the free trading of, or the public offering of securities, culminating in the issuance of free trading securities, without the issuer becoming subject to full SEC reporting obligations or Sarbanes-Oxley requirements. In connection with conducting Regulation A+ offering, an offering circular continues to need to be prepared in a now prescribed form, and that gets filed and qualified prior to sales. Qualification is akin to SEC review and issuance of a notice of effectiveness. So similar in concept to that process. Under the new rules, Regulation A is now divided into two tiers. Tier 1 permits offerings of up to $20 million in the aggregate in any 12-month period, and Tier 2 offerings in the aggregate of up to $50 million in a 12-month period. There are some significant differences between the two tiers. One of the most interesting is that Tier 2 offerings are now preempted from state registration requirements, and so in a Tier 2 offering, you've now got the ability to do a much larger Regulation A offering, up to $50 million, and it also eliminates the need to kind of wrangle with multiple regulators, so you're dealing with just the SEC in the Tier 2 context. So those two changes on their own should significantly increase interest and activity around Regulation A. Another interesting feature under Tier 2, an issuer can voluntarily, upon completion of the offering, voluntarily flip into full SEC reporting status in connection with a listing on a U.S. exchange. And so an issuer could use the Regulation A process in connection with its IPO and exchange listing. So both Tier 1 and Tier 2 share some requirements. Tier 2 has some additional requirements. Notably, a Tier 2 issuer must include audited financial statements in the offering documents, must file annual, semi-annual, and current reports prescribed by Regulation A, and those will be touched on in more detail a bit later in the discussion. And there are limitations on certain types of investors, so non-accredited investors. There are some investment limitations in a Tier 2 offering, and we'll touch on those a bit more in a few slides. So Regulation A Plus has been and continues to be available only to U.S. or Canadian issuers who have their principal place of business in the U.S. or Canada. There are some issuers that are deemed ineligible to use Regulation A. Those include current SEC reporting companies, blank check companies, and blank check companies are defined as companies that are in the development stage and that have no specific business plan or have otherwise indicated their business plan is to engage in a merger or acquisition with an unidentified company or entity. And so from a Canadian perspective, that would eliminate the ability of CPCs to use Regulation A Plus until after completion of their qualifying transaction. In addition, investment companies, so companies that are registered or required to be registered under the 1940 Act are ineligible, as well as companies subject to bad boy disqualification. And the bad boy disqualification is the same test as under Rule 506 of Regulation D, and effectively would render ineligible any company who has a director or officer or 20% holder which has been subject to effectively sanctioning by the SEC, a regulatory body, or a court in connection with activities around purchase or sale of securities. Under Regulation A Plus, the securities can be issued for either cash or non-cash consideration. So Regulation A Plus offerings could be used in the context of a business combination where the consideration being issued is either part or wholly securities of the acquirer. So those securities could be registered under Regulation A and issued on a free trading basis upon closing. Regulation A Plus also permits selling shareholders to participate in the sales, and there are limitations in the first year so that up to maximum of 30% of the total offering can be taken up by selling shareholders. At the end of the first year following the initial Regulation A offering, that limitation is lifted, but there continues to be a permanent limitation on any affiliate holders of the issuer securities, and that limitation is $6 million in the aggregate in any 12 months for Tier 1 offerings and $15 million in the aggregate for Tier 2 offerings. The way the rules are drafted limit, in some respects, some flexibility around how offerings are constructed. Some of the pricing rules really eliminate the ability to do at-the-market offerings or traditional issuer shelf offerings. So the ability for an issuer, a Reg A issuer, to put up a shelf with the intention of taking securities down off that shelf in the future at a currently undetermined price wouldn't be permitted. There are some delayed offerings that are allowed, which are limited to delayed offerings by selling shareholders, the exercise or conversion of currently outstanding securities, or continuous offerings that'll begin within 2 days and priced within 2 days of qualification and may continue for up to 2 years. But in practice, the rules really kind of limit the ability to do most types of delayed offerings. We touched a bit earlier on some of the investment limitations under Tier 2. And under Tier 2, unless the security will be listed on a national securities exchange at closing, any non-accredited investor is limited in their investment to, for a natural person, the greater of 10% of their annual income or net worth, and if a non-natural person, the greater of 10% of their revenue or net assets in the purchaser's most recently completed fiscal year. The rules do permit the issuer to rely on purchasers' representations as to their status and as to their income or net assets for purposes of determining their investment limitation. At this point, I'm going to turn over the presentation to Ken Sam. Ken is a corporate partner in our Denver office and co-chairs Dorsey's Mining Industry Group.
Thank you, Rich. So Rich has set us up and kind of explained the background and some of the requirements and limitations of Reg A+. And this section, we're going to talk about what you do to be able to complete a Reg A+ offering. So the first requirement is to prepare what's akin to a registration statement. Section 5 of the Securities Act requires registration in any offer and sell securities, and Reg A+ is basically an exemption. But it's modeled after the SEC registration process. So one of the things that an issuer would need to prepare is a Form 1A. And the old Regulation A had a similar form. The new regulation has Form 1A, and it basically has 3 parts to it. The first part is cover information about the issuer and the offering and capitalization, etc. The second part is what Canadians typically refer to as a prospectus. For Reg A+ purposes, it's referred to as an offering circular, very similar to an S-1 registration statement in the U.S. The third part are the signatures and exhibits that are required as part of the filing. And this offering statement is filed with the SEC. It has to be signed by the issuer, principal executive officer, principal financial officer, principal accounting officer, and a majority of the directors. Very similar to an S-1 registration statement in terms of filing and materials that are included. So the basic disclosure document that is provided to investors and potential investors is, again, what we refer to as the offering circular. Similar to a prospectus, the line items that you find in this offering circular include risk factors, dilution table, the plan of distribution that basically describes how the offering is being conducted, information related to selling shareholders if those selling shareholders are part of the offering, the use of proceeds, description of business, description of properties, MD&A. And one thing to note in the MD&A, if you have an issuer that doesn't have revenue during the last 3 years, they must include in their plan of operation a statement whether they need to raise additional capital in the next 6 months. The other thing that's applicable to the disclosure is that the SEC industry guides apply. So Guide 7 related to mining companies, Guide 4 related to oil and gas companies, etc. And then the balance of the information would be related to executive officers. And interestingly enough, when you read the instructions in Form 1A, it includes in executive officers the secretary. That I found a bit unusual. Executive officers, directors, and significant employees are required. There's required disclosure related to those, but it's in an abbreviated format. Compensation disclosure is required. For Tier 1 issuers, the smaller issuers, you can report that information as a group. For Tier 2, you report the 3 highest compensated executive officers and employees. There's a requirement to report security ownership of management and shareholders holding more than 10% of the issued and outstanding securities of the issuer, related party transactions, and there are different thresholds for Tier 1 and Tier 2, and then exhibits including material contracts and the things that you would typically expect in a registration statement. So some of the things that aren't required in the Form 1A or ongoing reports are things that are related to Sarbanes-Oxley compliance. And remember that Reg A Plus is an exempt offering, so the issuer typically doesn't become a reporting issuer, and it is generally not subject to most of the requirements of Sarbanes-Oxley. The Form 1A is subject to SEC review. And one of the interesting things that I think we'll learn as we start seeing these offering statements get filed is how long it takes the SEC to actually do one of the reviews and how extensive those reviews will be. Under a typical S1 or F1 filing with the SEC, we typically expect a 30-day review process. Again, there's no guidance from the SEC as to whether we're going to have accelerated reviews. There's also no guidance as to what they're looking for in terms of completeness of review. As many of you may have experienced in an SEC review, the types of reviews and the extent of the review can vary from reviewer to reviewer. Once the Form 1A has been filed, in order for an issuer to be able to sell securities under Reg A Plus, the statement has to be qualified, and that's analogous to an effectiveness on a registration statement with the SEC. Form 1A and all forms related to Reg A Plus offerings have to be filed on EDGAR. EDGAR is the electronic system that the SEC uses, and it's available to the general public. That means you essentially have to obtain an EDGAR ID prior to the filing. The other element for Canadian issuers in filing a Form 1A with the SEC would be that the Canadian issuer has to consent to service a process, and that's done by a Form FX. And it's quite customary for Canadian issuers that file registration statements and other documents with the SEC to file that form. The other thing that is very similar to the most recent set of rules and changes to the SEC filing process for emerging growth companies is that Form 1A can be filed confidentially. So an issuer that is looking or considering filing or launching a Reg A Plus offering, they can file the Form 1A confidentially, go through a set of comments with the SEC prior to launching the offering. And the advantage of this, of course, is you can keep your offering under the radar, and also you can gauge the quality of your disclosure without the need to file amendments publicly. And the SEC's guidance on this is that the the information statement has to be substantially complete. Prior to using the Reg A Plus, an official filing must be done at least 21 days prior to qualification. And qualification permits the issuer to sell securities to the general public. The financial statement requirements have been reduced for Reg A Plus. Both Tier 1 and Tier 2 offerings require 2 years of financial statements. And the big difference between Tier 1 and Tier 2 is that under a Tier 1 offering, the financial statements can be unaudited. And unless the Tier 1 issuer has audited financial statements available, there's no need to audit the financial statements. The other thing is the auditor doesn't need to be a peekaboo qualified auditor. With Tier 2, the financial statements must be audited. And if it's a U.S. issuer, it has to be audited in accordance with U.S. GAAP. Financial statements have to be prepared for U.S. companies in accordance with U.S. GAAP. And the audit standard has to be U.S. GAAP or peekaboo standards. So that means essentially that the auditor for a Tier 2 offering doesn't need to be a peekaboo auditor. Another item is Canadian issuers can prepare their financial statements under IFRS. The standard that they have to use is International Accounting Board standards. Oil and gas issuers have to comply with Rule 410 of Regulation S that governs oil and gas producing activities. The age of the financial statements requires that the financial statements, the balance sheet or the financial statements themselves, can't be more than 9 months old. And if the financial statements, if the Form 1A is filed after the 9-month period, then interim financial statements are required to be filed. By way of example, if you have an issuer with a December 31 fiscal year end, after September 30, those financials would be stale, and the issuer would have to provide interim financial statements, which can be unaudited, for a period after June 30th. And that dovetails with the semi-annual reporting obligations, which I'll discuss in a little bit. The other requirement might be related to acquired businesses or significant subsidiaries in which financial statements of those acquired businesses may be required, as well as pro forma financial statements. One thing that is not required, which will be a relief to a lot of potential issuers, is no XBRL is required in terms of formatting the financial statement. Well, no discussion is complete without discussing liability. And liability for Reg A Plus offering is expected to arise under Section 12A2 of the Securities Act, which basically says that any person who offers and sells securities may be liable for any untrue statement of material fact or omission to state a material fact necessary to make the statements in light of the circumstances in which they may not misleading. And this applies to any offering circular, which we have here, or oral communications. Now, there are two general defenses to a 12A2 claim. One is knowledge and exercise of reasonable care. The second would be that the material misstatement wasn't the cause of the loss. Undoubtedly, you don't want to put yourself in that situation if you're considering a Reg A Plus offering. The other question that arises is what are underwriters and agents going to require in connection with the Reg A plus offering? And we don't know for sure, but we would expect that negative assurance letters, similar to 10b5 letters, may be required in connection with Reg A plus offerings. So, Rich mentioned that there's ability to test the waters with Reg A plus, and so the question arises as to whether prior offerings are integrated with the Reg A plus offering that you're completing, and the short answer is no. With respect to future or subsequent offers and sales of securities, there's a laundry list of things that are excluded and not integrated in your Reg A plus offering. So compensatory plans that meet the requirements of Rule 701, offshore offerings under Reg S would not be integrated. Reg D offerings, 144 offerings, and even crowdfunding offerings once we figure out how that market develops. The test of water provisions permit Reg A plus offering and issuers to test the waters with potential investors both before and after the filing of the offering statement. And there are some things that you have to comply with in order to test the waters. And one of the things is a legending requirement on test of water materials. There has to be a statement that says no money or other consideration is being solicited. And if somebody sends that to you or sends you money, it won't be accepted. The second item is no sales will be made or commitments to purchase accepted until after the offering statement is qualified and a prospective purchaser's indication of interest is non-binding. There's a duty, if you use test of water materials, to redistribute and update after you file your preliminary offering statement if the test of water materials become inadequate or inaccurate in any material respect. So it's similar to a recirculation type issue. After the filing of the offering statement, the test of the water materials must be accompanied by the current preliminary offering statement. Or alternatively, you can add a note or a notice that where and how to obtain those materials, and so linking to URL would also work. I mentioned earlier that that Form 1As can be filed confidentially with the SEC, and again, before you can qualify, or before the SEC will qualify an offering circular, it has to have been officially filed for 21 days, and then after that, the issuer can actually accept sales. So all the test of water materials, again, have to be filed with the offering statement as exhibits. After the filing, the issuer can participate in roadshows. It's okay to actually make offers based on the filing, and again, the 21-day requirement. Issuers and participating broker-dealers are required to deliver a preliminary offering statement to prospective investors at least 48 hours in advance of sale when a preliminary offering statement is made during that pre-qualification period. Then after the final offering statement, after the sale, within 48 hours, the final offering statement must be provided to investors, and that has to be provided within 48 hours. So, Rich touched on the state blue sky exemptions. And really the reason that the old Reg A wasn't a very effective tool was because of potential state regulations. Interestingly enough, the SEC views Tier 1 offerings as basically local offerings. And because of that, what they've done is they have not preempted state review of those offering circulars. So in order to do an effective Tier 1, the offering either has to be completely outside the United States, or you need to comply with the state blue sky laws, including potential qualification by coordination. Now, NASA is a national organization of state regulators, and interestingly enough, one of the things that they commented on after Reg A Plus was adopted is basically they felt that this set of rules basically takes away a lot of their power. But notwithstanding that, in a Tier 1 offering, you can still use their coordinated review process. Basically, you email to NASA the offering document. They'll assign a lead reviewer, and their goal is basically to turn comments in 21 days. So when you look at that and compare it to the 21-day review period, it might work. With respect to Tier 2 offerings, however, state law is preemptive. And what that actually means is there's no requirement or there's no obligation to require state review of the information circular. Instead, what states may require is that you file notice and pay a fee with the state, but again, no review. And if the issuer decides to list on a national exchange such as the New York Stock Exchange, MKT, or NASDAQ, there are no state filings or reviews because of preemption. So post-closing, there are filing obligations for Tier 2 issuers. For Tier 1 issuers, there's a requirement to file what's referred to as a Form 1Z, and I guess Z means it's the end, so completed. And there's information that's required in that Form 1Z that basically provides information for the conclusion of the offering, and that has to be filed not later than 30 days following the termination or completion of the offering. For Tier 2 offerings, there is ongoing reporting, and the annual report that's filed by a Tier 2 issuer is a Form 1K, similar to 10K, except the disclosure is abbreviated, relaxed, and that annual report is required to be filed 120 days after year end. And that too is in three parts. There's the first part, issuer information, the second part, disclosure, and the disclosure has the same elements you would expect in an annual report like a Form 10K. The other report that is more periodic is the semi-annual report, and that is filed on Form 1 SA assuming stands for semi-annual, and that must be filed within 90 days after completion of the second fiscal quarter. It's very consistent with a Form 10Q, which are filed quarterly by SEC reporting issuers, and it requires the issuer to include unaudited financial statements for the 6-month period, MD&A, and material updates or material disclosure that's not otherwise included in a current report. And the current reports are reports similar to Form 8K filed by reporting issuers, and that's filed on Form 1U. Form 1Us are due within 4 business days of a material event, and material events are defined through a laundry list of items, including fundamental changes, bankruptcies, material modification of shareholder rights, changes of auditors, non-reliance, change of control, and also unregistered sales of 10% or more of the issuer's outstanding securities. And again, all filings need to be filed on EDGAR. Because Reg A Plus doesn't trigger SEC reporting, there's a laundry list of items that fall outside of the typical reporting. So things like Section 16, Schedule 13D, beneficial ownership reports, tender offer rules, proxy statements, etc., as well as the rules under Sarbanes-Oxley. Since it's not a reporting issuer, Sarbanes-Oxley would not apply. So how do you exit the reporting system once you're in? So a Tier 2 issuer can suspend reporting by filing a Form 1Z. And remember, the Form 1Z was the termination report filed by Tier 1 offers. And this can be filed if there are less than 300 holders of record. It can't be filed until after at least one Form 1K has been filed. And in order to count the number of holders of record, you basically order up your CDS and CD & Co. reports, but you're not required to look through the brokers. And it's noted that most public companies, or many public companies, have fewer than 300 holders of record. And once that's filed, then the reporting obligation is suspended. The other consideration in completing a Reg A Plus offering, and a lot of the factors free trading securities, is, well, what type of market can develop? Well, we had mentioned earlier that a Reg A Plus using a Tier 2 can flip into SEC reporting with a listing on a national exchange. And they basically would file a Form 8A. For those issuers that have no desire to become a full SEC reporting issuer, there may be other markets that are available to them. In order for them to identify those markets, there's the OTCQX, the OTCQB, the OTC Pinks, and those don't require SEC registration or reporting. And the process for obtaining a ticker symbol and listing on one of those quotation mediums is what they're referred to. A broker-dealer or participating broker-dealer would file what's called a Form 211 under Rule 15C211. And basically, there's a requirement for those broker-dealers to have completed basic due diligence on the issuer and have a reasonable basis for believing that the information is correct. The SEC has specifically said that the Form 1Ks, the 1SAs, the Form 1Us, as well as the Form 1As, meet the standard for this disclosure obligation, and as well as disclosure obligations for Rule 144 and 144A. So with that, I'm going to turn it over to Chris Dirksen, who is a partner in our capital markets group in our Seattle office and the firm's Blue Sky Specialist. Chris?
Thanks, Ken. Well, that was a lot of information for everyone to digest. So now might actually be a good time, rather than waiting till the end, if you have questions in the back of your mind that haven't yet been answered, if you want to plug those into the chat box so that Ken and Rich can be taking a look at those while I'm continuing the presentation. And then if we have time at the end, we'll attempt to address those questions. So guess you're all interested in the practical aspects of this. So what does all of this mean? And I think the upshot for Canadian companies, remember first of all that we're talking about companies that are not SEC reporting, because SEC reporting companies are not eligible to use Reg A+. So we're talking about two types of Canadian companies that might use this: companies that are listed only in Canada or in offshore markets like AIM, and Canadian private companies that aren't traded anywhere. So we've been working with that market segment for a long time, and given the options that have been available in the past for Canadian companies in U.S. fundraising, typically, our clients at least have always wanted to use an approach that doesn't take a lot of time and money, doesn't raise deal uncertainty due to the involvement of regulators. There's typically been a preference for offerings that don't require the preparation of a detailed offering document, unless, of course, people are interested enough to do a full-blown U.S. IPO. So we think that for Canadian companies that have the ability to complete a deal and don't need the added benefit of being able to do a full public offering in the U.S., the Regulation A+ will probably not be used a lot in those situations. So, for example, if you have a Canadian bought deal, a short form prospectus, or if you're doing a private placement with no offering document, we don't see Regulation A+ being used in those situations, because that would significantly alter the timing of the deal and what you need to do to complete it. We do think that there are some situations where Regulation A+ may be interesting for Canadian companies, and we'll focus on a few of those situations now. One is Canadian companies that are privately held and are doing their first IPO. So in that situation, they're already going to be preparing a Canadian long-form prospectus, going through a potentially lengthy review process in Canada. And to help with the size of the deal and the pricing, those companies may be interested in doing a Regulation A+ concurrent offering. We're of the opinion that the $50 million limitation would only apply to the U.S. tranche of that offering. So, the company could do basically an unlimited sized Canadian public offering with a concurrent U.S. offering on a public basis of up to $50 million without taking on the full SEC reporting obligations. And as you've heard, there may be some ongoing reports in the U.S., but there's also the potential to suspend those in the future depending on the number of record holders. That same approach could also be used for any other offering that involves the long-form Canadian prospectus, although we're not seeing many of those these days for companies that are already public in Canada. One interesting question is, could a Canadian company do a standalone Regulation A+ offering with no companion Canadian public offering? And we understand that there are differences between the rules in the different Canadian provinces, and the answer may depend on where the company is incorporated in Canada, where its headquarters, mind, and management are located. For example, we understand from our friends in British Columbia that in British Columbia there is basically a rule that if a company is domiciled there and doing an offshore offering, there is a requirement to put a legend on the securities if there's been no Canadian prospectus filing. So for BC-based companies, they may not be able to do a direct Regulation A+ offering with no Canadian prospectus. But we have seen deals involving other jurisdictions or Canadian incorporated companies that don't have significant ties to Canada that have done offerings in the United States with no Canadian legend. And so companies that fit into that category may be able to do this kind of offering with no Canadian prospectus. A third situation that we see where Canadians might significantly consider Regulation A+ is Southbound M&A. As some of you may know, the United States does not have the ready availability that Canada does for a plan of arrangement structure where you go into court and have a fairness hearing in order to take advantage of the SEC's Section 3A10 exemption. In Canada, Canadian companies are used to being able to do that, which gives you the exemption to issue to U.S. people free trading securities. Very, very few jurisdictions in the U.S., including few of the significant ones, allow that kind of process. So on U.S. M&A, people are usually trying to identify, is the company held by a small number of accredited investors from whom you can get investment representations at closing to make sure that you can rely on an exemption. And we do sometimes see deals where Canadian companies want to acquire a U.S. company, and maybe they have 100 shareholders, and there's always a representation at the front by the target side. Oh, we know all of these people; they're all accredited. But when push comes to shove, they can't find all of them, and there's some uncertainty about the availability of an exemption. In the past, we've had to tell people that can't identify a clear exemption, well, you're going to need to do an SEC registration statement to do this acquisition and become a full SEC reporting company. Well, now with Regulation A+, you may have an alternative. You may be able to rely on Regulation A+ and not become full SEC reporting. And if the deal is, below $20 million in market value, if you can identify blue sky exemptions at the state level, you may avoid any kind of ongoing reporting obligations for that M&A deal. So, it's going to be deal specific, but that may well be a useful alternative to a full-blown SEC registration statement. On the U.S. side, for U.S. companies, we think Regulation A+ will be much more broadly appealing than it is for Canadian companies who have alternatives that they can pursue in Canada. We see this particularly being attractive to smaller, well-established U.S. private companies that have maybe tapped out their private funding sources. Maybe they're not the type of company that's going to grow into a billion-dollar company. Maybe a company more in the $20 to $50 million range that's looking for some more money but doesn't have an easy private option. This provides a way to be able to offer securities publicly without resale restrictions, and can be an incremental step toward full public company reporting. We do expect that because of this, as time passes, there will be a certain segment of the U.S. broker-dealer community that will be, developing a strategy around, what kinds of companies are they marketing Reg A+ deals to, and what are their procedures for those kinds of deals. Now, what about the Canadian connection? So here there's, I think, a very interesting potential use for the exemption is U.S. companies doing offerings in Canada. Under U.S. law, there is a requirement for a U.S. company to put a U.S. legend on securities that it issues outside the United States, absent an SEC registration statement in most cases. And so the typical structure by which U.S. companies are now going public in Canada is finding a shell company in Canada, whether it be a capital pool company or something else, doing an RTO of that company so that the public vehicle remains Canadian, and then going through a fairly convoluted restructuring process to make sure that that company qualifies for foreign private issuer treatment under the SEC rules. That requires basically an M&A transaction where the U.S. target shareholders are asked to approve exchanging their shares for shares of a Canadian company. Often to avoid foreign private issuer status, the shareholders may have to take non-voting shares in the Canadian company. There's significant tax work required in these deals. These deals are very, very expensive to document and implement because it requires extensive U.S. and Canadian advice. Well, Regulation A+ would provide an alternative that companies could consider, which is to just have a U.S. company do an offering in Canada under Regulation A+ of up to $50 million U.S. You would be adding an additional regulator with the SEC, but you'd have a much more straightforward deal structure. The shareholders would not need to digest becoming shareholders of a Canadian company. You'd eliminate a lot of the planning, and you would just coordinate the document between the Canadian and U.S. filing requirements to have one document that you're using for the offering. One disadvantage of that approach, though, is, as you heard, some of the limitations on Regulation A+ going forward. If the company is one that would need to do significant financing in the near future, it would not be in the same position as other Canadian companies in raising money in Canada. Future offerings would need to comply with the U.S. domestic issuer rules. So that may be a disadvantage.
Thank you, Chris. We're at the end of our presentation, but we might have time for a couple of questions. To the extent that questions aren't addressed on the call, we will answer the questions that have been submitted, and there have been several. One question that was asked is, what happens if a new company doesn't have a 2-year audit history? And the short answer is you audit for the period that the company's been in existence. Another question that we've received relates to does Reg A+ apply to rights offerings and takeover bids? And Rich, I think that's a question for you.
Yeah, so Regulation A+ would be available for takeover bids where the consideration in the takeover bid is the securities of the offeror, within obviously the size limitation. So you could employ Regulation A+ to issue ultimately free trading securities in a takeover bid, and Regulation A+ would be available for rights offerings from a Canadian company.
Okay. I think that concludes our time for the webinar. And Rich, do you want to wrap it up for us?
Sure. I just want to thank everybody for participating today. We hope that everyone found this useful. To the extent, as Ken mentioned, there were some questions asked that we didn't have enough time to get to. We will endeavor to get to all of you over the next couple of days. To the extent you don't hear from us in that time frame, or otherwise want to reach out on other Regulation A+ questions or any other questions related to Canada-U.S. cross-border activity, please feel free to reach out to any of the three of us. Dorsey has a leading Canada practice group whose members are all practice only U.S. law representing Canadian-based clients with respect to their United States business activities, including all aspects of cross-border securities activities. And so, feel free to reach out to us with any questions you may have, either on Regulation A+ or otherwise. Thanks again to everyone.
And finally, the PowerPoint slides that we use for the presentation will be emailed. We also plan to post those slides on our website and invite you to forward those to anyone that you might think might be interested in the materials. Thank you again.